Hello, and welcome to Dynamic Scoring the Presidential Candidates' Tax Proposals. Today you're going to hear about the economic impact of Donald Trump's and Hillary Clinton's tax plans from Ben Page, Senior Fellow at the Urban-Brookings Tax Policy Center, and Kent Smetters, Bentner Professor at the Wharton School of the University of Pennsylvania. Their presentations will be followed by a Q&A session. Please submit questions at any time by typing in the box on the upper right-hand corner of your screen. Professor Smetters, please tell us more about today's presentations.
Thanks, Kimberly. So we've been working with the Tax Policy Center on creating analysis of the two presidential candidates' tax plans. It's been a real pleasure to be working with TPC because, like us, they are completely non-normative and all about the numbers. And so how we work together is that they are doing the static score estimation and as well as some short-run elasticity based dynamic analysis that Ben will explain. And then we layered our dynamic model that I'll explain on top of their static estimates in order to come up with a dynamic score. So Ben will talk about the TPC model for about 15 minutes, and then I'll come back. Ben, take it away.
Thank you very much, Kent, and thank you very much for all the work you and your team have done on this and for putting together this presentation. I want to start by saying a few words about TPC's, the Tax Policy Center's conventional analysis of the presidential tax plans. That analysis was released last week, and I encourage everyone to look on our website, taxpolicycenter.org. It has a very detailed look at what the tax plans do. And those are going to be updated later this week with the dynamic estimates that we're going to be talking about today. So that conventional analysis, and that's what Kent referred to as a static analysis, uses a micro-simulation model based on over 100,000 tax returns, so it's able to analyze at a very granular level the revenue effects of tax plans. And we don't usually like to call it a static model, actually, because it does allow for behavioral responses. So, for example, if a plan increases marginal tax rates, people may take more deductions. They may engage in other forms of tax avoidance. And so taxable incomes might fall and revenues not rise by as much as you otherwise would think. Another example is if there's an excise tax on a certain type of good, consumption of that, purchases of that good may decline. Taxes on capital gains can alter capital gains realizations. So there's really a very rich array of behavioral responses that are allowed for in this model. But, however, it does not incorporate any changes to macroeconomic variables like output, inflation, unemployment. And those are the type of effects that we're going to talk about today. Next slide, please. So TPC is just a very broad view of TPC's analysis of the Clinton plan, the conventional analysis. In broad strokes, the plan raises marginal and average tax rates on many high-income households. Lower-income households get tax break, largely through an increase in the child tax credit. There are some increases in business taxes, mainly on international transactions. And overall, the Tax Policy Center estimated that plan would increase revenues by $1.4 trillion over the next 10 years. So pretty significant tax increase. Now, the Clinton plan might include also increases in spending that would offset a lot of that effect on the budget. But by itself, the tax policy would tend to reduce deficits significantly. So, next slide, please. How would the Clinton plan affect the economy? Well, the biggest effects are, first of all, it reduces after-tax incomes on net. Like I said, some families do get a tax cut, but on net, incomes are down. People have less to spend, and that tends to reduce economic activity in the short run. It increases marginal tax rates, once again, on average. On labor income, with less earnings per hour, people have less incentive to work, and labor supply is reduced. It would increase marginal tax rates on capital income, so things like interests and profits, and that reduces the incentive to save and invest. And finally, by itself, it would reduce budget deficits, and that tends to free up savings to be invested in real capital rather than in government bonds. So that tends to have a positive effect on the economy. Next slide, please. The Trump plan is in some ways a mirror image because it involves tax cuts for most families. Those cuts are largest in both dollar and percentage terms for high-income households. And it also reduces taxes on corporate and other business income. And the Tax Policy Center estimated that this plan would reduce revenues by $6.2 trillion over the next 10 years. Very significant tax reduction. Next slide, please. So the Trump plan would have kind of the opposite effects of the Clinton plan in the main. So it would increase after-tax incomes, people that have more to spend, which would give a short-term boost to the economy, reduces marginal tax rates on labor income, which tends to encourage labor supply, reduces marginal tax rates on capital income, which tends to increase private savings and investment. And the plan also includes some particular incentives for investment that would encourage firms to invest more. And it, by itself, would increase budget deficits, reducing the national savings available for productive investment. Once again, the Trump plan might include cuts to spending that would offset this, but by itself, the tax plan would result in a very large increase in deficits. Next slide, please. So I just want to say a few words about dynamic scoring in general. This is the exercise that we're going through today, and the idea is that dynamic scoring incorporates effects on the macroeconomy, so moves beyond the conventional analysis that I just talked about. And in theory, if we can reliably predict the economic effects of a tax plan, then this should give a more accurate view of the effect on revenues. And in addition to hopefully improving our forecast of the revenue effects of the tax plan, the effects on the economy are of interest in and of themselves. A lot of times the purpose of a tax plan, or one of the selling points, is what it will do to the economy. And that may be one consideration when we're trying to decide what tax policies to pursue. But really, there are other features of tax policy that are kind of more central than these macro effects. Tax plans will change the level of revenues, and that's important because it determines the income that's available for the government to spend on its various policies. And tax policies can change the distribution of income. So those two features are kind of how much taxes do we want to take in, and who's going to bear the burden of those taxes. And the macro effects of tax policy in a well-functioning economy like the U.S. economy tend to be fairly modest. So it's really kind of affecting the economy at the margins. It can be an important consideration, but perhaps not the most central consideration. Next slide, please. So we're going to talk about two different macroeconomic analyses. I'm going to talk about the estimates using our Keynesian model here at Tax Policy Center. And in that model, macroeconomic effects are driven by changes in aggregate demand, the amount that consumers are spending and firms are investing. This model relates aggregate variables like overall output, inflation, unemployment. So it's kind of at a high level. This is that the estimates are made. In this model, output changes relative to its potential level. So you can have changes in unemployment. The economy can operate above or below potential in the short run. But after a few years, the economy returns to its potential level. The overlapping generations model, Kent will talk a lot more about that, the Penn Wharton Budget Model. But just by way of contrast, it's estimated at the household level. So it involves households making decisions about how much to work and invest. And they respond to incentives in the tax system. They are forward-looking, so it's not just today's policies, but future policies and economic conditions that influence them. And in that model, output always equals potential. So in some sense, the Keynesian model is modeling, to my point of view, is modeling kind of an additional effect. But the results that I'm going to be talking about are really only half the equation. So we're working here at Tax Policy Center on a model of potential to integrate with this Keynesian model. But for the moment, I'm just giving kind of the half the story, the changes in the economy relative to potential. Next slide, please. Okay, so the Tax Policy Center Keynesian model estimates effects on the economy in two stages. So first, there are direct effects on demand. So this is, for example, if people receive more income, they may buy more. And then there are indirect effects of that initial change in demand. So it kind of cycles through the economy and produces additional changes. The model has a range of assumptions for the impact of policies on the economy. Some assume that the economy is more responsive, some less. So this kind of gives an idea of the range of uncertainty in the estimates. And we assume that these Keynesian effects operate only kind of in the medium term, and they fade away within 4 years. Next slide, please. So I'll say a little bit more about the direct effects on demand of tax policy. For example, if there's a tax cut, people's after-tax incomes go up, and they're likely to spend some of that additional income. So that adds directly to demand. We assume that lower-income households tend to spend more of an additional increment to income than higher income households do, consistent with economic research. And our assumption is that the lowest quintile, the lowest 20% of households, will spend about 90 cents out of each additional dollar of after-tax income, whereas the highest 20% of income earners in households will spend just 55 cents out of each additional dollar. The model also incorporates the effect of changes in investment incentives. This can increase the amount that firms are spending on capital investment, which also can add to demand. And finally, higher wealth, changes in wealth levels, also can change the amount that people spend, in addition to changes in their income. So those kind of direct effects, those are kind of the immediate effects on demand. Next slide, please. But there can also be indirect effects. So those direct effects can generate further effects as they cycle through the economy. So on the plus side, if people are spending money, this could lead firms to gear up production to hire more workers, which then adds to incomes. Again, firms may invest more, so you could get an additional positive effect that way. And the amount that people are spending, that's income to someone else. So as that cycles through, that can further lead to increases in demand. On the minus side, when demand, the kind of demand increases and the economy starts to heat up, this can lead to higher interest rates, and that would reduce investment spending and spending on consumer durables and offset some of the direct effects. In the next slide, please. And in normal times, the Federal Reserve will tend to offset expansionary fiscal policy by raising interest rates to prevent inflation from rising. In a deep recession, like the one that we have just been through and are still recovering from, the Fed cuts rates almost to zero, and so there's no room for them to change rates. Rates will tend to stay constant and will not offset a boost to demand. And our assumption is that for 2017, we're kind of in between those two worlds. The Fed has started to raise rates, but they seem to have paused, and it's not clear. It seems that they would be less responsive than usual to changes in demand in terms of changing interest rates. So we assume that in 2017, indirect effects would offset just about a sixth of the direct effects. So there would be less than a one-to-one, but only a little bit less than a one-for-one effect of demand on output. And in later years, we assume that half of that of the direct effect is offset. So an increase in demand of $1 would only increase output by 50 cents over several quarters. Next slide, please. Let's see. So what are the main features of the Clinton tax plan that would impact the economy? Well, it increases taxes on average for households. With lower incomes, people will spend less, and that's what the Keynesian model is taking account of. The biggest increases fall on high-income households, so that tends to mute the change in spending. And once we put all this together, next slide, please. It's hopefully is Figure 1. What effects do we estimate on GDP? Well, in 2017, we estimate that the central estimate is that it would decrease output by 0.5%, but there's a range of estimates ranging from 0.1 to 1.2%. Those are the three bars under 2017. In 2018, the central estimate is that it would reduce output by 0.2%, with a range from close to 0 to 0.4%, and then decrease output by smaller amounts in later years. Next slide, please. So those impacts on GDP then influence after-tax incomes and I mean taxable incomes, and therefore affect the amount of revenues that are generated. So what this Figure 2 shows is the dynamic effect on revenues. So this is just the additional effect that's layered on top of the conventional estimates due to changes in the economy, in the macroeconomy. So the central estimate is that in 2017, the reduction in output that the tax plan would cause would offset about $15 billion of the increase in revenues in our base estimate, with a range of between a reduction in $3 and $34 billion. And in 2018, about $10 billion of the tax increase would be offset by lower output, with a range between $2 and $23 billion, and then revenues would be affected by smaller amounts in later years. Next slide, please. Figure 3 puts these dynamic effects in context by showing them in the context of the overall effect on revenues. So the top of the bars in each of each trio of bars for every year is the conventional estimate of the effect on revenues, and then the orange squares at the top are the dynamic effects, which are subtracted from those conventional estimates because we estimate a reduction in taxable incomes due to the plan, and the blue part of the bars is what's left over if you take account of both the conventional and dynamic estimates and add them together. So you can see that there's a fairly substantial offset in 2017 in our central estimate, but relatively modest offsets in later years. Next slide, please. So now I'll turn to the Trump tax plan, and as I said before, it essentially is a mirror image. It's cutting taxes for most households, which tends to increase demand as people have a higher after-tax income. Once again, the biggest cuts in this case go to high-income households, and which tends to mute the effects on the economy. And in addition, this plan includes a provision to allow firms to expense their investments, to write off the full value of investments in the year that they're made, and that tends to encourage firms to boost investment spending, so adds an additional boost to the economy for that reason. Next slide, please, which should be Figure 4. So what does the Keynesian model estimate the overall effect on GDP would be? In 2017, the central estimate is a boost of 2.2 percentage points to the level of GDP, with a range from 0.5% to 4.8%. In 2018, the central estimate is a boost to the economy of 0.7%, with a range from 0.2 to 1.5%, and then smaller amounts in later years. Next slide, please. And once again, that boost to the economy increases taxable incomes and generates some additional revenues that offset some of the revenue losses from the tax plan. So this figure just shows the additional effects of the dynamic effects, and those would add, by our central estimate, $53 billion, or they would reduce the revenue loss by $53 billion in 2017, with a range from 16 to 155 billion, and they would reduce the revenue loss by $35 billion in 2018, with a range from 5 to 50 billion dollars. Next slide, please. And so this once again puts the effect on revenues in context. The full length of the bars is the conventional estimate of the effect on revenues, and once again the orange squares, in this case at the bottom, are the dynamic effects. And you can see that in our base estimates, the offsets to the revenue losses are fairly modest. So that's all I have to say. I'll turn it back to Kent.
Thank you, Ben. And I just want to remind everyone to submit questions by typing in the box on the upper right-hand corner of your screen. Professor Smetters, can you tell us about the Penn Wharton Budget Model?
Sure thing. Thanks, Ben. And so let's talk about the Penn Wharton Budget Model. And first talk from some slides, and then we'll go into the actual simulator that you can play with online with me while we're actually doing this. And so at a big picture, why is Wharton involved in this public policy analysis? And it's really consistent with our overall mission at Wharton to use advances in theoretical modeling, big data, analytics, cloud computing to really help businesses make informed decisions in terms of operations and marketing and so forth. But one of the big missions that we have is also to use these tools to also help influence, I'm sorry, not influence, but to describe the impact of public policy, and in particular, in a completely non-normative way, just show whether they're different effects. And so we've broken it down into several models. We have a static microsimulation model that has a rich set of heterogeneity, a dynamic model that we'll present today, a large data store that we use for model calibration, and cloud computing. So I'll show you results live, and even though the model will take sometimes an hour to run each combination, we've used cloud computing to pre-compute every single combination so that you get instant feedback. And so for this exercise, we've integrated with the Tax Policy Center static model, and Ben corrected me, call it their conventional model, with a few series that's coming from our own microsimulation static model so that we can also do debt calculations. As Ben pointed out, households in our, we start at the household level, and our microsimulation model literally has hundreds of thousands of census-level households, and then we kind of build up from there, and households make decisions about how much to work, save. They, based on current conditions, about their expectations of the future, including uncertainty that they face, government policies. And then capital and labor markets are what determine ultimately the wages, the return to capital owners, and so forth. And in the short run, we also have Keynesian effects as well. In particular, many of our households are poor, and so they will be borrowing constrained. And so when you give them money, as Ben pointed out, they tend to consume most of the money that you give them, 90% or even more. And so that is, in fact, in the model. and as well as other constraints that are associated with kind of short-run Keynesian effects. So you'll see for like 2018, our numbers and the TPC Keynesian numbers are fairly compatible. And then what's the kind of some big enhancements that we've made? The first one, and we'll see how this is absolutely critical for the analysis. Many academic models, as well as many of the models that are used in Washington, actually are only analyzing tax changes that are essentially revenue neutral, or that households don't care about government debt, because if you give them money today, they simply save it all and they give it as larger bequests to their children. And so the model that we're presenting today really is a serious attempt to model the impact not just of changes in marginal tax rates, but also the impact of changes in government debt. We also have a very robust international capital flow assumption system, and we allow you to make changes of different assumptions. And then we take really seriously how we model the U.S. tax system. It's complicated. It's a hybrid system of residential and territorial. There's also the corporate sector. There's the pass-through sector. So we spent a lot of time really detailing that and making sure that our dynamic estimates are consistent with the Tax Policy Center estimates on, for example, corporate versus pass-through. And then we use from our data store, here's just a partial list of government data sets that we're using and census level data that we're using to calibrate the model. We take calibration fairly seriously, and we go back in time to see how well the model would have been done in the past. Okay, so let me switch now over to the website itself. And this website, the simulation is now live on the website. If you're in front of a web browser, just go to it, and you can see that the URL, it's at the bottom of the slides I was showing you, but it's simply just type in budgetmodel.wharton.upenn.edu, and you can hopefully see it on your screen, the URL up here. Just again, budgetmodel.wharton.upenn.edu, and you'll see the top banner is Tax Policy Simulator. You can either click on that, or if you want to, you can go to our simulators button here, which has all simulators, and you can get there through click on the interactive simulation. If you want to read more of our write-up on how we're summarizing things ourselves, there's a read more button there. So let's click here. And just to work through the simulator quickly here, what we're showing are different key graphs that people care about, things like GDP, GDP per capita, worker, hours worked, capital services. And if you ever see a plus button, that means you can expand on it and get things like revenues, including by sources, tax revenue from labor income, capital income, other revenues. We can even scroll down a little bit and see things like deficits, debt, and so forth. Okay, and so this particular graph is on GDP, and down here we're showing the different plans, Trump, Clinton, the House GOP plan. And for this exercise, since we're focusing mainly on Trump and Clinton, I'll remove the House GOP, which you can just do by clicking the labels. And if the label does not have the word with dynamics in it, this means it corresponds to the static or conventional analysis that's consistent with a Tax Policy Center. And if it has dynamics, it means it has our dynamics on top of that. And then over here on the left side, you have different options. These are economic behavior assumptions that you're free to change. You can go to the little I button here that gives you information. If you want even more information about it, you can go a little crazy and look at that. And this is the assumption about how robust are international capital flows into the United States. So at 40%, which is our default value, that means every additional dollar of government debt that's issued by the United States, 40% of that is in fact financed by foreigners. And so that relieves some of the pressure on the U.S. economy because if it wasn't financed by foreigners, then that government debt would compete with U.S. household saving against private capital, and it would crowd out private capital. And then there's some other assumptions, things like how much does labor supply respond to an increase in the after-tax wages, how much does savings respond to an increase in after-tax capital income. And then Ben pointed out we're, for the most part, just focus on the tax side, but the candidates have also talked about, at least at a high level, what are their spending priorities. They're a lot less specific on that, so we don't want to take an exact position, but this dial control allows you to, in fact, change and say, if I think Clinton will spend a little bit more and Trump will spend a little bit less, you're free to change that dial control to see the impact of that. All right, so I'm going to actually, given our limited time, focus really on what's the most important one of these, and we'll see, and you can see this just by playing with it yourself. And as you click around, you'll see the series instantly update in front of you. And again, the reason why is we pre-computed. There's actually 256 combinations here, and we've pre-computed every single one. And so that's why you're getting this instant feedback. Okay, so on the screen, let me take away the static score so we can really look at dynamic here. And in particular, this is the most important assumption, again, is the foreign investment flows. And let's take in a really extreme assumption. Let's assume for every additional dollar of government debt that's issued to pay for a tax plan, or that's reduced because a tax plan saves that money, 100% of that is financed by new foreign capital coming into the United States. What we can see in that case, that the Trump plan, which is red, Trump is red, Clinton is blue, the Trump plan does well relative to the current law, which is this dark, solid, dark blue, black line. And the Trump plan, in fact, always has a higher GDP. Clinton's is slightly less than current policy would give you. And however, if we went to the opposite extreme, and this is why this is such an important dial control, suppose that we said 0% of the new government debt that's issued by the government is in fact financed by foreigners. In this case, things change dramatically. In particular, what happens is that the Clinton plan has a small little negative originally, but it goes positive and is now actually above current policy, whereas the Trump plan goes a little positive at the beginning and then goes negative over time and falls quite a bit below current policy. Both of those extremes, 0% and 100%, are unrealistic for reasons I'll explain in a little bit. We think 40% is more plausible and consistent with the empirical evidence. And what we see here is that in the short run, under 40%, that Trump actually does get a short-term boost and then eventually falls below GDP. That would have been under current law, whereas Clinton goes negative for a little bit, as Ben pointed out, but then eventually goes slightly positive relative to current law. What's going on? What explains why foreign investment flows is so important here? And you can go to the menus yourself and just look at revenues. In particular, as Ben pointed out, the Trump plan loses quite a bit of revenue over time. The Clinton plan, however, actually increases revenue. And so as a result of that, you get very different pictures when it comes to what's called debt held by the public. So there's two concepts. One is deficits. Deficits is simply the shortfalls in a given year. And we see that current law actually is on pace for a very large deficits going forward. The Clinton plan reduces them a little bit. The Trump plan increases them quite a bit more. The debt held by the public is the accumulation effects. And in particular, this is how much debt the government has to service at any given year. And the black line is current law, again, increasing quite substantially. And the Trump line is again the red, and the Clinton is the blue. So what you're seeing in terms of effects for GDP is essentially that in the short run, the Trump plan is in fact stimulative, and that is it raises GDP because of these both short-run Keynesian effects as well as improvements in marginal incentives for saving, for investing, for supplying labor. And you can actually go and look at if you care about that, things like hours work, capital services, and so forth to look at that. But then over time, what's happening is that even though incentives were improved, just the sheer revenue shortfall is increasing over time. That's leading to more debt. And with the increase in debt, that debt now competes with private capital for both household saving as well as international capital flows. And since international capital flows are not financing 100% of it, only 40%, that competition is quite real. And we get this crowding out effect. And by the way, even if you reduce government spending under, say, Trump, but we should point out this is excluding Social Security and Medicare, just all non-Social Security and Medicare spending. And granted, Social Security and Medicare are very large components now of the budget, and only getting bigger. But even a 10% reduction doesn't overcome the negative effect. We have to actually go up closer to 50% reduction in federal outlays, not including Social Security and Medicare, for the Trump's GDP to not fall in over the long term. Okay, so let me go back. Let me give you now some summary numbers, and let me go back to my slides. And here are some summary numbers of the changes in GDP. In particular, we're showing in 2018, the Clinton plan will reduce GDP by about 1.19%. By 2018, the Trump plan will increase GDP about 1.2%, a little bit more in 2017. You can see the numbers for yourself if you want to look at 2017. But by 2027, at the end of the 10-year window, things reverse. In particular, the Clinton plan is now up by about 0.4%. The Trump plan is now down by about 0.4%. And this is the amount of GDP that they have, that we're projecting that they're creating relative to the GDP that would have otherwise existed in that year. So this isn't a one-year change. It is the cumulative effect. And by 2040, we're projecting that the Clinton plan will have 1.19% GDP higher than it otherwise would have been in that year on their current law, and the Trump plan will be down about 6.7% GDP. And again, what's explaining this? There's lots of things going on, but the real big driver is simply this debt accumulation that we talked about that's competing for household saving. Okay, so let's talk about jobs. And before turning to jobs, I want to really point out jobs are by far one of the more controversial, not just in terms of the press, but also controversial in how we model job numbers. And it's actually not a direct output of our model. It's not a direct output of most models. Instead, typically when people are forced to ask about jobs, they use certain rules of thumb to translate changes in GDP to jobs. And I've been asked about jobs quite a bit, even when we released the House GOP plan previously. And the way we can really decompose things is really two margins. One that economists care about. The first one is what we call the intensive margin. The intensive margin, by definition, says any changes in GDP has no impact on jobs. It's exactly zero. And the reason why the intensive margin, it basically says, suppose that all the changes in GDP are only due to the fact that current workers are working harder, that is, if GDP went up, or if in fact GDP has gone down, it's because current workers, people who already have jobs, are working less. And so by definition, if we only looked at the intensive margin, there would be no change in jobs. The opposite extreme is to look at what's called the extensive margin. And with this margin, it's making the opposite kind of extreme assumption. It's saying GDP per worker has not changed at all. And so if GDP itself is going up or down, it must be because you're adding workers or reducing workers for purposes of expanding or contracting GDP. So at the extensive margins, also an extreme assumption, but it kind of paints the outer bound. It's kind of the upper bound on job creation or job losses. And so let me show you what only the extensive margin results here. And for 2018, what the extensive margin says, again, this would be a worst case scenario, would that be that the Clinton plan would reduce jobs by about 280,000. The Trump plan would increase jobs by about 1.7 million. However, within 10 years, things switch again. By 2027, the Clinton plan goes just the opposite. It's now producing 645,000 more jobs than otherwise would have existed in that year, whereas the Trump plan is down 690,000 jobs relative to what otherwise would exist in that year. And by 2040, the Clinton plan has 2 million more jobs relative to what would have otherwise existed, and the Trump plan is down 11 million. Now, remember, these are both worst-case scenarios. If it's a negative number, that's a worst-case scenario. If it's a positive, that's like a best-case scenario. Empirically, it looks like the extensive margin is slightly less important than the intensive margin. So another way of saying that is that if you are looking for what I would consider a best guess of these numbers, is that whatever the number says, multiply it by 0.45. Take 45% of that number, and that's about how the intensive and extensive margins appear to empirically kind of balance out. So in the case of the Clinton plan, for example, for 2018, my best guess would be a loss of about 126,000 jobs. My best guess for the Trump plan would be about a gain of about 768,000 jobs. But again, take all those numbers, multiply by 0.45. But the reason why we have to be modest here, lots of controversy amongst economists exactly what the right multiplier here is. Any number between 0.3 and 0.6 is well within reason of the range of estimates out there. So don't look at these numbers and just say, okay, this is our prediction of the job numbers. Rather, these are kind of worse than best case scenarios, and then you want to multiply, in my opinion, closer to 0.45 to get a better estimate. But again, this is not a direct output. Given just advice, because I'm always asked by media how to translate things into jobs, and that's how I do it. Okay, so the most controversial assumption is by far, you can play with this yourself on the website, is by far the level of foreign investment flows. So let's talk a little bit more about that one. Why do we go with 0.4 or 40%? And the intuition here is that on one hand, there's no question capital flows are quite robust. We see this from the graph that's on your that's on your screen here, is that as national saving rates have gone down in the United States, international capital flows have unquestionably increased to help make up for some of that difference. However, let's break it down into two ways here of thinking about what's a good number. First, let's just look at Treasury debt. And what we want to know is when the government issues $1 more of debt, how much of that is typically purchased by foreigners? And the historic average is around 40%. This is sometimes called the average marginal effect. In particular, it's how much as the government issues $1 more debt, how much more is bought by foreigners? It's about 40%. That's been the average over the last 15 years. However, if anything, we actually think 40% is maybe on the upper side of international capital flows. There's actually a well-known puzzle known as the Feldstein-Hirioka puzzle that shows that then the puzzle is why doesn't capital flow more than what what our theoretical models suggested that it should flow? And this puzzle's been around for quite a while. If you look at the current data, and granted that original study was old, but if you look at current data today, only about 18.5% of all financial securities issued by the domestic sectors, including federal, state, and local governments, is actually held by foreign entities. That number is actually lower than government debt. And the reason why is government debt, U.S. government debt, is very ubiquitous. It's very homogeneous. It's well known. It's viewed as a safe instrument. In fact, Japanese insurance companies are allowed to hold U.S. government debt as part of their safe reserves. They're not allowed to hold a lot of our other corporate debt and other types of equity and so forth. So we think 40%, if anything, we're being fairly generous on that. And also keep in mind, there's no free lunch. If more capital is coming into the United States, this also means foreigners are, in fact, purchasing more of our capital stock. They're owning more of our capital stock. And we'll actually have a financial account balance series. We'll be adding it to this our live website graph and just likely by tomorrow, so you can actually see that. Okay, so what's the main takeaways here? There's no question, historically, business investment has indeed declined in the United States. It's just a matter of fact that the U.S. corporate statutory rate is higher than other developed markets. And so what the Trump plan in particular does is that it tries to doubly encourage capital investment by doing two things. One is, Ben pointed out, this expensing. What is expensing? Expensing, sometimes called bonus depreciation, is the idea that we will allow companies to depreciate for taxable purposes their capital at a rate that's faster than the actual rate of depreciation of that capital. So it's sometimes called accelerated depreciation. And there's fairly large agreement amongst economists that expensing actually is fairly powerful at stimulating investment. We even see that in our own graphs as well. And the reason why is that it only rewards new capital investments. It doesn't reward existing capital investments. The Trump plan at the same time also, however, reduces the corporate income tax rate. And what that does is that actually is not just simply rewarding new capital investment, it's actually rewarding as well existing capital investment. In fact, because of how the Trump plan works, except for housing, new capital will actually be fully expensed in the Trump plan. And so by reducing the corporate tax rate, it actually only rewards, in their plan, the existing capital stock. And so that's actually working the opposite direction, because by rewarding the existing capital investment rather than just new capital investment, that makes debt higher than otherwise would have been. So they would actually get more investment simply by focusing on the expensing margin. Now, for those of you who are economists, you know there's even more complications here, and that is if, in fact, the world has things like called economic rents and so forth. Whether you want to tax those rents is a big debate. It comes down to where the sources of rent. Is it because of market power or things like rewards for taking on risk, like entrepreneurial risk? And that's a debate we've sidestepped here. But at the same time, I think it's a very legitimate debate, and it's something that we're aggressively kind of invested in to understand it a bit more. So the bottom line is the Trump plan stimulates more GDP and jobs in the very short run, but underperforms current policy as well as the Clinton plan within the decade, the standard 10-year window. And so the success of the Trump plan really hinges critically on trying to find substantial cuts to government spending down the road to essentially pay for their tax plans. Okay, and that's basically it that I have. And so again, you can go onto our website and look at the simulators. If you want to, again, see our brief, we'll actually have a link down here, right here, this link at the bottom. If we go back to the website for just a second here, this link at the bottom is an issue brief that talks about the different assumptions that we're making, the ranges, how we came up with it. We also have, again, a separate issue brief that you can look at right here. That will that just provides a summary, or if you're looking kind of for takeaway numbers here, it provides a summary of the different Clinton versus Trump plans. All right, so that's it, and I turn it back to Kimberly.
Thank you, Kent. And I just want to remind everyone to please submit questions by typing in the box on the upper right-hand corner of your screen. And Ken and Ben will be answering questions now. So first of all, I want to say that the slideshows will be available on the Penn Wharton Budget Model website after this presentation. And Ben, could you tell us a little bit about what reports are available on the TPC website?
Well, I think the most relevant ones are the ones that I mentioned, the analyses of the Clinton and Trump plans. So those should be right on the front of the TPC website, and they just go through in much more detail the exact provisions in each plan and the amounts of revenue raised or lost by the different provisions. So I encourage everyone to take a look at those.
Great. And Kent, this question's for you. Why are your results so different from the ones produced by the Tax Foundation's model?
Yeah. So there's a couple things that's going on here. The first one is that the Tax Foundation model uses what's called a neoclassical representative agent model. So you have one person who represents the entire economy who lives forever. In that model, that plays no role. In particular, this model has what's called the recording property, where if you give this representative agent more money today, he just saves it because he knows he has a future tax bill to pay for it, or he's going to pass it on. If you view the representative agent model as a proxy for an intergenerational model where he's replaced with a child exactly like him, that tax money is saved completely for that child. And what we saw in our results is that indeed, if there's not much debt effects, like we're in a small open economy of 100% capital flows, then the Trump plan actually does fairly well. And the main feature here is this competition for private capital, however it's coming from debt. Our numbers in the small open economy case are still a little bit smaller than the Tax Foundation's model. And I believe that what's the main driver there is that we actually start out in a hybrid, rather complicated tax system. It's not true that companies are not able to fully expense they're not able to partially expense their capital investments today. Even on current law, there's some partial expensing going on. And so when we change from partial expensing to full expensing, the change is not as big as you might otherwise view it if you were ignoring the current base law rules. And then on top of that, then when you reduce the corporate tax rate in our model, since new capital is already untaxed at the margin, that actually does not have a positive effect. It actually has a negative effect because new capital is allowed to be fully expensed. It's already untaxed in present value at the margin. So then when you lower the corporate tax rate, that actually adds to even more debt than otherwise would be necessary. And so the main features that seem to separate the models is, again, the role of debt as well as the modeling of the hybrid tax system.
And a second one for Kent. So when you're talking about jobs, you mean changes relative to the baseline and not changes relative from one year to another. Is that right?
That's right. And that's a very important distinction. In particular, when we talk about jobs, we're really talking about how many jobs would exist, or under our projections would exist, relative to a current law in that particular year. So it's not like in a given year, if we went back on our slides and take 2040, it's not like an additional 11 million jobs are lost under the Trump plan in just that year. Rather, that's the result of the cumulative effect. So what we're saying in 2040, if Trump doesn't find ways to pay for his plan, we'll have 11 million times 0.45. So call it 5 million fewer jobs than we otherwise would have had in that year. Again, relative to current law.
This next question is for both of you, but Ben, I'll let you start. So is it possible that other policy changes could offset some of the policy changes caused by these tax plans? Is there any way that you could comment on that?
Sure. I mean, as Kent kind of discussed, the policies that would have the biggest offset would be to change other parts of the budget so that the tax plans didn't impact the deficit as much. So, in particular, for the Trump plan, the effects would be much more positive if you found offsetting reductions in spending elsewhere in the budget, because most of the negative effects that Kent's estimating are due to those increases in deficits. In principle, it's also possible that changes in regulations and other policies like that would also impact the economy, but we'd really need to know the specifics on those. The devil would be in the details as to how any changes like that would affect the economy.
Kent, anything to add?
Yeah, and that's exactly right. This is one reason why we have this dial control on our website, so that right now the candidate's spending side is a lot less specific than our taxes, and we just don't want to venture with making details that they haven't themselves made available on their spending side. So therefore, the dial control at the bottom allows you to either increase or decrease spending. You'll notice for the Trump plan, at least in the out years, even a 10% decrease in non-Social Security, non-Medicare spending. So again, Social Security and Medicare are big parts of the budget. So we're talking about a smaller base here, but even a 10% reduction in that is not enough to bring Trump as GDP back to the current policy in the long run. It takes a larger amount, like a 50% reduction in non-Social Security, non-Medicare spending for that to happen. Now, as Ben also pointed out, regulation, we'd have to know. Well, some changes in regulation could actually increase output, some could actually decrease output. Trade policy, some of that could increase output, some of that could decrease output. We would just have to get much more specific numbers and points from the candidates to figure out how that would then layer on top of that. And one last point, and I think this is really important, is that there's lots of various analysis. As I like to always remind people, and this is me kind of putting my academic hat on, is that all models are wrong. I mean, all models are wrong. They're always making some assumptions that won't come to pass. I mean, if we were in 2005, we would never have predicted the events of 2008 that led to a substantial reduction in GDP, a substantial increase in the debt held by the public. So there's no question all models are wrong. What you really want to take away from it is not specific numbers. You really want to take away kind of relative magnitudes. Wherever GDP happens to end up in a couple of years, because of things that we can't anticipate, financial crises, everything else. The policy that we're looking at, the relative positive versus negative relative to whatever current policy would have actually given us, that's what I take away from it. Is it a big change? Is it a small change? Is it positive? Is it negative? And not focusing so much on the specific numbers.
Thanks, Kent. Ben, can you tell us if there were any major tax proposals that there wasn't enough time to include in the model?
You mean provisions of these plans, or?
Yes.
Well, I think that there were some features that weren't described adequately, that weren't detailed enough to be included in the conventional analysis, and so those would also not be reflected in the macro analysis. But I don't think that there are major provisions of the tax plans that would have serious macroeconomic effects that were not modeled.
Yeah.
Do you have?
Yeah, I do. For example, for the Clinton campaign introduced the child tax credit earlier last week, and that's actually been included in both the TPC static or conventional analysis as well as our dynamic analysis. As Ben pointed out, it's not so much about Trump. I mean, in the case of the House GOP, they had some things in terms of related to the ACA that were a little less specified, how they were going to replace some things with a credit. but that credit itself was not specified. And so I think there are always, when we face a lack of details, we have to try to make a reasonable call. In some cases, we just kind of say we can't include it because it's just really unclear. I think that for at least the Trump and Clinton campaigns, the details are most of the major features and even most of the minor features were in fact included.
Thank you. And we had a question. Kent, could you explain in a little more detail the how the Penn Wharton Budget Model and TPC static and dynamic scores are combined? Are there times when the static scores might be different?
Yeah, that's a good question. No, by construction, in fact, this is why we integrate with the TPC so that we can have kind of one presentation here. If you go to our website and you look at the it's again the series of, let's say, Trump versus Clinton, the series that does not have the words with dynamics in there. And again, you can click on and off which series that you want to look at. You can hover your mouse and get exact numbers that we're producing. And so the static analysis of Trump and Clinton is by construction consistent with the static or conventional analysis that is given by TPC. And I don't mean broadly consistent. I mean year by year the numbers are consistent. Then the dynamics is all coming from our model. It's not including the elasticity estimates that Ben was talking about earlier. And so so all the Keynesian effects and so forth are coming from our kind of building up from the household level up type model. And that is what we do with that model is that we compute what's called dynamic deltas that allow us to figure out relative to the static estimate, what's the impact on of this policy on things like GDP, revenues, and the capital services, labor hours, and so forth. So bottom line, the static results that's shown on our website are exactly consistent with the TPC numbers.
Thanks. And so we've got time for one more question, and I'll let you each address it. Ben, if you would go first. So although cutting spending would reduce the negative effect of debt on GDP, would it also reduce demand and then have a negative effect?
Yes, absolutely. That's a very good point. So I was thinking more of the long-run impact, but if you cut spending, and it would actually depend on exactly what type of spending. So if you offset, for example, all of the Trump plans revenue losses with cuts in spending, you wouldn't have the short-term boost in GDP that I estimated with the Keynesian model. And indeed, it's possible if it's direct government spending, that influences demand dollar for dollar, whereas the tax cuts, only a portion of them are spent. So if you have equal changes in government purchases of goods and services and that offset the tax reductions, you'd actually have a negative short-run effect. So that's very true. The thing that you wouldn't have is the negative effects of increased deficits on potential in the long run.
Yeah, and there's a definite distinction between long run and short run here. The long run numbers would be more positive for the Trump plan in particular if there was less debt. In the short run, what would happen, even in our dynamic model, it comes down critically to who are you cutting spending for. If you're cutting spending that largely hits kind of higher income people, and that may have be kind of easily replaced by them, they dip into their savings a little bit. To offset that. If the spending cuts were focused more on lower income households who are kind of more hand to mouth, and that is they just have lower savings, and so that anything that you do in terms of the after-tax bill or services is going to be one-for-one impact on them. That would actually have a more negative effect even in our model if it was focused on them in the short run.
Well, Thank you very much, Kent, and thank you very much, Ben, and thank you all for joining us today. I just want to remind you that the slideshows and this webinar will be available on Penn Wharton Budget Model's website following the end of this webinar. Thanks.
Thank you.